have had two negative quarters in a row. One thing that makes it complex is that we came off a number of quarters in a row of very strong growth, especially in both both nominal and real terms. And so, for example, one of the more stricter ways to look at a recession, if you're kind of determining how severe one is to look at the year-over-year real GDP. And so most recessions in modern history would have had negative, slightly negative year over year. Whereas, for example, we've not met that yet. But of course, no one's using that as their recession term. But it shows kind of like why there's some debate here because so far it's kind of a mild recession. One way that I'm looking at it, I think a little bit different than many analysts is I think the labor market is weaker than it looks like, and that's because of the inflation component. And so, for example, wages went up pretty significantly in the past year, but they went up significantly less than inflation. And so basically the average worker got a pay cut over the past year at a much deeper rate than is normal. It's one of the worst years ever for inflation adjusted wage growth. And so if I were to, ultimately when we look at the labor market, we want to know what is the potential for consumer demand. And so, for example, if I was running a company and I, fire 2% of my employees, or I gave all of my employees a 2% wage cut, the aggregate buying power of my employees went down either way. And so I think that the labor market dynamic is kind of lagging and wonky here because of the inflation component, and that it's kind of masking the current level of weakness. But then I also agree that as we look forward a little bit, we're probably going to get more actual, outright weakness in the labor market as well. So I think we'll be in more recessionary conditions later this year. Going into this year, I was emphasizing cash, healthcare stocks, energy pipelines, energy producers. That's kind of the outlier compared to a normal recession. I've been more bullish on energy than most. As far as bonds, so it's funny because I've been a structural bond bear for quite a while, especially in real terms. I was expecting high inflation for a couple of years now, so I've been avoiding any sort of duration in my portfolio on the bond side. But once we did start to get that 3% rate on the 10-year, I actually did put some of my cash into that middle of the curve, so the 7 to 10-year type of bond exposure. So I'm actually fairly bullish on bonds on a risk-adjusted basis as, say, a 6 to 12-month trade here compared to how I normally am. And so basically, in responding to market conditions, the bond market was unattractive going into this year, in my view, just because of that inflation component. But once it got deeply oversold, and once we started to see some of the signs of potentially some disinflationary pressures, I've been moderately bullish on bonds. The way I've been kind of characterizing this environment is that I have a long-term inflationary outlook for this decade, but inflationary decades can still have disinflationary pullbacks. And so I generally view us as being in a disinflationary period within an inflationary, longer term cycle. Well, 2020, you saw a big spike in unemployment. You obviously had lockdowns. You had that whole, disinflationary spike happen. You had shortages. I perceive this one as more of a malaise, right? So I view it as somewhat stagflationary, meaning slow or negative real GDP growth, but still inflationary pressures emanating from the supply side, specifically the energy capex or lack thereof, and that is also inclusive of transportation and refining and things like that.
Yes.
And so the way that I'm interpreting this, I would generally agree with his description that I think it's going to be longer and that it's in large part engineered. So the Fed can't do anything about the supply side. They just have to hope the supply side works itself out while they try to curtail demand. I think the problem there is that we're not really seeing much response on the supply side. I think, in some areas we are, right? Because, the logistics, they got messed up. You see some resolution there around the margins. Also, during 2020 and 2021, there's a big rapid shift in consumer demand for things. So they, because of lockdowns, they wanted consumer durables and they wanted homes and they didn't want other things. And now we're seeing some normalization there. But I think that we're kind of stuck in a malaise until we have more abundant energy. And so I think that it's kind of like, they're holding a beach ball underwater, but because of how much debt's in the system, the question is how long can they do that for? So my expectation is they don't get back to a period of structural positive real rates, even though they can potentially get there for a period of time. So I think for the general consumer, it will come down to, wages that are having trouble keeping up with inflation, And then I think that as they try to curtail demand, I think, yeah, you're going to get a weaker labor market. And we're already seeing early signs of that. So rising initial jobless claims, a contraction in job openings, which I think is already somewhat of a flawed metric anyway. And so I think that's what they basically have to look forward to. And on the other hand, they could get falling mortgages again. We've already kind of seen coming off the highs. So some of the things that seized up months ago could start to become a little more accessible for consumers that are in a stronger position. So I think it's going to be somewhat mixed based on someone's own situation. But I think it is going to be a tough couple quarters. Well, I put a couple things together. One, as he pointed out, you've had a so far permanent reduction in the number of people that are even in the labor force. So I think that's contributing to the shortage. And then even among people in the labor force, you have a significant degree of turnover. And I think a lot of that's related to the fact that, as I pointed out earlier, we have some of the lowest, the most negative inflation-adjusted wage growth we've seen in a very long time. And so if you're working at a job and you got a 6% wage increase and, inflation is 9%, and, let's say some of the components of inflation, like food at home, is up like, 11%, 12%. High protein foods are up 14%. That's going to cause a lot of discontent with the workers and being able to track workers for those prices. And so because wages are sticky and kind of challenging to move around, one way people adjust their wages is they leave one job and they seek out another job. And so I think it's the combination of things together. It's the inflation makes longer term planning harder, right? And that includes employee retention. And then you also have just for a variety of factors that permanent or semi-permanent reduction in the labor supply. And so I think it's those two things together. There's a couple ways to look at this. One is that if you look back in history, anytime the employment rate goes up 50 basis points, it almost always keeps going. It's very hard to have a little bit of a recession in basically because it feeds on itself. And so if you look at the Fed's economic expectations, they were writing that they expect unemployment to go from 3.6% to 4.1%, and then basically stay around that level, which is basically the Fed's trying to hope that it's different this time, that they can have just a little bit of a recession and just a little bit of normalization without causing that vicious cycle of employees lay off people spend less, so companies do worse, so they lay off more people and go from there. I think how high employment gets is largely a function of what policymakers do. And that includes both fiscal policymakers and policymakers at the Fed. So in big disinflationary crashes, like say 1929, 2008, those were periods where banks were taking on way too much risk. They had very poor, if you look at their total loan book, they were very skewed towards riskier things. They weren't holding a lot of super safe collateral as a percentage of their assets. And so you had severe banking crises in those periods. Whereas now you have a pretty well capitalized banking system, and we have more inflationary conditions in general. So those are types of environments where you're generally less likely to get those huge spikes in unemployment. But again, it largely depends on what policymakers do in this type of environment. The more they try to tighten fiscal monetary policy, the more they could potentially get an increase in unemployment. Whereas if they ease back on some of those, they could potentially keep unemployment on the lower side. So it depends on if they want the system to kind of suffer from fire or ice, inflation or disinflation.